Well, hi there. My name is Andy Multer. I'm a student at the University of North Texas. I'm working on an MBA in finance, and I just want to introduce you to my idea for a financial capital investment trust, or FICAT as I like to call it. So, Financial Capital Investment Trust. The FICAT is a new, innovative investment instrument it's intended to be traded in the money markets where the maturities are a year or less and the interest rates are small. So, I think it's similar to T-bills, where you get 4 week maturity up to a year maturity, uh, and these instruments are similar to how a T-bill is traded. You can sell them, and then they can easily be bought and sold in the secondary market through brokers through a bid-ask spread. But the underlying asset is financial capital, which is cash, so it makes it highly desirable. Uh, the end user of these FICAs are large and small lending banks. So these banks use the financial capital as a source of funds, which they can use to create the wide array of loans that they already service to the public. So, so businesses, they're the ones that have all the money or a lot of money. And the wealthiest of individuals, I think they're the best candidates to purchase these FICAs, and then which the banks use as a funding for their loans. So I just, FICAT, corporations, wealthy individuals. And my idea is that they use pre-tax dollars to purchase these FICATs. I don't want you to think, though, that, we're avoiding taxes here. The taxes are definitely getting paid. In fact, there's more taxes getting paid. But we'll get to that later on in the presentation. Um, the FICATs, they earn interest at a competitive money market rate. So, like I said, um, they're like T-bills. They'll have similar uh, rates, probably like 2%, or for the purpose of this video, saying 2%. Right now, I saw that T-bills are trading like 1.4%, but I think 2% is a reasonable number for example purposes. Um, and because the underlying asset is cash, uh, it makes it very liquid. So, and I can see where if you have one of these, yeah, you can get assurances when if you need to make a payment, like, oh, I've got this in the FICAT that's going to be given to you, so here you go. But yeah, just like T-bills, they can be bought and sold in the same day. So taxes are paid upon selling the FICAT in the secondary market or at maturity, unless the money is reinvested into more FICATs. Um, and then the interest earned is taxed at the corporate or the capital gains rate. I wrote corporate, but the capital gains rate. So the principal taxed at the corporate rate, and the dividend is paid as taxed at the capital gains rate, 15%. So why is this a good idea? Is this a way for the wealthy to avoid taxes? Well, not at all. Like I said, there's more tax revenue collected by the federal government with these FICATs. More wealth is created, and people have more access to loans. So, I think this is just all around just a really beneficial instrument for society. So let's take our current situation. Now, let's say a company has $1 million of taxable income, and this $1 million, this is not all of their taxable income. This is just a small portion. Let's say this company has a total of $50 million of taxable income, but they only want to use $1 million of taxable income for their FICAT. Um, the current corporate tax rate is 35%. So we take a million times 35%, and that's $350,000. That's $350,000 that goes straight to the federal government, where they use it for all their different programs and military. And we, the corporation, only have 600. All right, so let's just take a look and let's see what would happen if we were able to defer these taxes and purchase these FICATs. So the dividend and the tax on the dividend column on the left. So we take that $1 million, and we say that our interest rate on these FICATs are going to be 2%. Uh, so that's a $20,000 dividend. And then, like we said, Uncle Sam, he gets his cut, 15% on dividends. So at 15% of $20,000 is $3,000. And the next column on the right, the tax on principal and discounted. Well, that's $1 million. And like we said, corporate tax rate, 35%, $350,000. Now, keep in mind, that's $350,000 a year from now, and we want to know what today's value is going to be. And the way we do that is we divide by where our discount rate will be, which will use the inflation rate of 2%. Now, right now, inflation, I think, is a little over 1%. But for the Federal Reserve's goal right now is 2%, so we're just going to go ahead and use that number. So if we divide $350,000 by 1.02, we'll get $343,137. And now the tax revenue on the dividend that we collected on the far left column, $3,000, we're going to discount that by the inflation rate as well, 1.02, which equals $2,941. And now the far right column, we'll add those two tax revenues together, and we get $346,078. There we go. All right, so all right, so now we're looking at on the far left column, the discounted dividend. We got 17,000, and we want to, that's $17,000 a year from now, so we want the present day value, which we're going to divide by 1.02, which equals $16,667. And so now we get to see what we have if we didn't, if we deferred taxes. We'll see what we're going to get if we don't defer taxes. So on the second column, discounted dividend without the tax shield, well, that's $650,000, and we get a 2% interest rate on that. So $13,000 dividend. And hey, just because we took out taxes doesn't mean we're not going to take out more taxes. So so we take out that 15%, and after that 15% tax taken away, we're left with $11,050. But remember, that's a year from now. We need today's value. So we divide by the discount rate of 1.02, which is $10,833. Now you kind of see where this is going. The next column on the right, I'm just dividing 16,667 by 10,833, which shows that by deferring those taxes, which are definitely getting paid, there's a 53% increase in the dividends, which really helps the bottom line for these companies, that employ people, give away to charities. And now on the far right, let's take a look. So, originally, no FICAT, $650,000 after taxes. Well, but with the FICAT, a year from now they get taxed $650,000, divided by the discount rate, $637, $637,000, plus that $16,000, almost $17,000 dividend, we get $653,921. So, all right. So what do we have now? So we got the revenue for the firm, which is $653,921 versus that $650,000. So you see, like, hey, the corporation is actually doing okay. I mean, that's $653,000 today versus $650,000 today. So with just the use of an instrument, they're doing almost $4,000 better than they were without it. Now let's look at the right. 346,078 versus 350,000 for the tax revenue collected by the federal government. Well, that doesn't seem right. Kind of looks like we just took that 3,900 from the federal government and gave it to the corporation. Well, that's pretty much exactly right. But like I said, the federal government is definitely going to get their taxes. Don't worry about them; they're getting theirs. They always will. So, we're going to look to see how that federal government is going to get their money. So don't forget about the banks and their new loans. Okay, that's the whole point of these FICATs, is that banks are able to create new loans, which they create many different types. These are just a few: home mortgages, automobile loans, and business loans. And it's important to remember, So let's say, for example, in this presentation, we're doing $1 million for FICAT. Um, Banks are required to keep a certain percentage of their deposits in the Federal Reserve or in their vaults. So, you go to the teller and say, hey, I want $200 from my checking account. Well, that's part of the required reserves set by the Federal Reserve for their bank deposits. So when we give the banks $1 million, 100,000, 10, we're going to use 10% because that's the max. It goes from 2% for small banks to, with small amounts of deposits to, 10% with banks with large deposits. So we're just going to go ahead and use the max, 10%. So $1 million, 10%, they have to keep $100,000 in reserve. That means they have $900,000 available to give out as loans. And so for this presentation, we're going to create three different loans: the home mortgage, the automobile loan, and $1,000. All right. And now for this presentation, I'm using a financial calculator using the Texas Instrument BA2 Plus, if you know what that is. Um, and I'm keeping the numbers fairly simple. Um, Just want anybody that knows how to use a financial calculator to easily follow along, and also using these simple numbers, 15 years at 5% instead of 180 payments at 5% divided by 12, or even doing continuously compounding. I'm just trying to show easy numbers for the presentation, so we can definitely get more advanced if you wanted to, but by keeping it simple, like the future value number on the left column is actually is about $11,000 smaller compared to using monthly payments. So this actually kind of helps my case, show that small numbers still make a big difference. So let's go back to this loan amount, 300,000, 15 years at 5%. The financial calculator, I'm using present value. You can see that in the bottom of the footnote. Present value is 300,000. N is equal to 15, and the interest is 5%. The future value is going to equal $623,678. Now remember, this is how much the bank is going to receive over the course of the 15 years. Well, remember, we don't want to know how much we're going to have at the end of that period. We want to know how much all that money is worth today. So, like we did earlier, we're going to discount that $623,679 by our inflation rate, which, for when we have multiple years, you take that to an exponent. So 1.02 to the 15th power, divide that into the full amount of the loan, which gives us $463,402. And now we want to subtract away the loan amount of $300,000, which gives us a gross income for the bank of $163,402. Now, a bank is a business. They have their own overhead. They got buildings. They got all their employees with salaries and benefits. So not all of it is profit. So we're going to say that after all their expenses, including the interest to the loan, I know I subtracted the 300,000, whereas they're paying 300, plus that 2% that I told you about earlier for the dividends. That's included in the 75% of costs and expenses. So, but the 25%, that's their net income before taxes. So 25% of that 163,000 is $40,851. And well, guess who's there at the door with their hand out? Is of course the federal government. They need their 35%. So 35% of 40,000 is $14,298. And then so after you take that chunk of change away, the banks are left on the far right column with $26,553 for their profit. The next button ahead of time, but I guess I kind of forgot here. But so we just get to kind of hang out until it goes to the next slide. Okay, here we go. The automobile loans. All right, so now we already talked about the home mortgage. Now we're going to go into the automobile loan. So $300,000. Let's say you get 8 people that we can cover with this $300,000. They each get a car. Medium range price. Nothing too cheap, but nothing like too expensive either. And for the time period, I could have gone with, 6-year loan or something like that, and it would have made my numbers a lot bigger, make this FICAT look amazing, like, oh man, he's making, $200,000 on a $300,000 loan. Like, I don't want to, I don't want to make it seem unreasonable. I'm trying to, so I went ahead and just went, it was the smallest reasonable car loan out there, 3 years, 5%. Um, and I understand that 5% is a little high, possibly for a car loan. But I'm just, I'm trying to be consistent in my percentages here. And like again, I use my financial calculator. You can see on the bottom, 300,000, n equals 3, interest equals 5, and the future value is equal to $347,288. And remember, that's 3 years from now. So we want to find out what that value is today. Well, take that 347,000 divided by 1.02 to the third power, and that gives us $327,000, $257,000. You know what I'm trying to say. And then we just subtract the $300,000 loan, which gives us gross income today of $27,257. Okay, well, remember they got their own costs and expenses at the bank, so really their net income before taxes is 25% of that $27,000 number. So we got $6,814, and of course Uncle Sam right there, ready to get paid. Uh, it's very easy to pay the federal government, but getting them to do something, that's a different story. uh, but anyways, so 35%, they Uncle Sam gets $2,385. And after we take out the tax cut, the bank is left with, on the right column, $4,429. Now, so we said a home mortgage loan, a car loan, and now let's say a business loan. Now, typically, I was thinking maybe I'd use a 10-year loan or something like that, but for this business loan, I'm just going to stick with a 1-year loan. This is the kind of loan that a small business needs to kind of refresh their supplies for the year, and then uh, so it's a short-term loan. The bank's not going to make much money, but it's quick money, so they're happy. So, small business, they borrow $300,000 for 1 year at 5%. PV on a financial calculator equals 300,000, n equals 1, interest equals 5. The future value is going to be $315,000 1 year from now. So, of course, next column, we're going to divide that 315,000 by 1.02%, which gives us $308,824 today. And we then, of course, subtract the $300,000 loan, which gives us $8,824. Well, after covering costs, expenses, salaries, benefits, they're left with 25% of that $8,824, which gives them $2,206. And of course, Uncle Sam wants his money, so 35% later, the federal government gets $772, and the bank, after they get their tax cut on the far right column, gets $1,434. So I think we're starting to see here that for these three loans, the middle column here, you'll see that the taxes collected are $14,000, $2,000, and $772 for a grant, for a total of $17,455. And the revenue realized by the bank is 26,000 plus 4,000 plus 1,400, $32,000, $416. So for all that $900,000 loans that they're giving out, the bank is making $32,000, which it's that's not a small number, but you see what kind of margins we're talking about here. But that $32,000 would not have existed if it wasn't for these FICATs, hypothetically. And the 17,000 the bank or the federal government wasn't going to get. But wait, now hold on a second. This business loan, somebody's making money off this business loan, so let's take that into some consideration here. Oh yeah, well actually here, let me go back here. So So let's just kind of like recap. So we got the revenue for the firm was $653,921, which is higher than their 650,000 if this FICAT didn't exist. Well, okay, so the revenue, the firm that just wants to tuck money away for a little while, they're making a small bit of change. And remember, this is not an investment fund like index funds or stocks in a corporation or creating a new project that's going to make them millions of dollars. Um, this is specifically for the purpose of getting small returns, but for absolute no risk. Okay, um, and then we go up to the top and we see that we got our last table here. And so on the bottom right, tax revenue collected by the federal government. Well, we got that original 346,000, which was less than that 350,000, but we add that $17,455, which gives us that 363,000, which is higher than $350,000. Well, hey, well now we're doing all right. But like I said, that business loan, somebody used that to make money. Well, let's at that as well. Okay, so that business owner, he got that 300,000. If you look back on the slide, um, the total he paid back was $308,824. And since we're using 25%, we're going to say that his net income before taxes is 25% above that loan amount. So $386,030. Um, and then we subtract away the loan amount in the second column, which gives them a gross income of or net income of $77,206. And so on the next column on the right, this is we'll pretend this guy's a LLC. So he's not getting taxed at the corporate tax rate. He's actually getting taxed at his personal tax rate at his income level, which here is $77,206. Which I know it seems not much on a $300,000 loan, but keep in mind he probably has a couple part-time employees, has a lot of other costs that this loan didn't cover. But yeah, anyway, so he's 77,000 times 25% for his taxes equals $19,302, and then his take-home pay, you take away that big 19,000 chunk, and 77,000 minus that 19,000, well, that's $57,905 for him. So, well, so now let's put all that together. So again, on the bottom left, revenue for the firm, you got $653,921. So the firm got more money. And then on the bottom right, tax revenue collected by the federal government was 346,078 plus 17,455 plus 19,302. That equals $382,835, which is $32,835 more than that 350,000 that they originally would have collected. So the firm, they make a small, marginal gain. The federal government, they realize a lot more in taxes, and at the same time, a bank made some nice revenue. Someone was able to buy a house. 8 people were able to buy cars. The business owner was able to take out a business loan to help support his family. And this is all just from a 2% dividend on a FICAT, which was pre-taxed, before taxes. I mean, I'm feeling pretty good about this. I hope you are too. But of course, I'm sure you have some questions and concerns. Who wouldn't? So, we'll go through all these. These are some of them that I've come up with. Why will banks borrow from this new money market instrument? Isn't a FICAT just a negotiable CD? Do FICATs compete with T-bills? Well, why don't the banks just borrow from the funds from the Federal Reserve? And how can we trust that the banks won't just make too many bad loans? Will this cause another recession like in 2007 from the subprime loan lending crisis? And how will FICATs be traded? How liquid are FICATs? Which countries can use this instrument? And what are the different reasons why a corporation would be interested in investing in the FICAT? Well, here let's go ahead and go through these, and I'll answer. So, so why will a bank borrow from this new money market instrument? Well, excuse me. A FICAT is a new source of funding similar to that of a savings account, for deposits. So basically, a bank, they go out and they get their customers, and their customers, put money into a deposit, a savings account or a checking account, and the bank, makes loans on that. Uh, and it, my second point here, the cost of acquiring a FICAT will be much less than acquiring new customers to place the deposits into the bank. So, when banks have to spend a lot of money and time trying to market themselves to these potential customers, try to bring them in the door so that they'll, make these deposits with them. Whereas with a FICAT, I believe it'll be the investment banks, not the commercial banks that are making the loans, but the investment banks that do deal with like stocks and bonds. I believe they'll be the ones being the brokers. They'll shop it around to the different banks, and the banks will, say one day like, yeah, we want, $250,000 in a FICAT, we want half a million. Um, which if you think like they attract a customer, like, oh, maybe they'll get 5,000, or maybe this guy got 25,000. It's they're going to be able to just quickly get a lot more funds in such a short amount of time. Maybe, I don't know, $20 generation fee for these FICATs for $1 million of loans. I don't know what the fees will be, but I mean, this is going to be very cheap instead of trying to get all these customers. Well, and then also the cost of acquiring the FICAT will also be less than selling negotiable CDs, because negotiable CDs are also short-term, short-term maturity funds, similar to that, like a T-bill that banks create for themselves, which they sell to their customers, and well, primarily to like businesses. So it's similar to what I'm talking about with this FICAT, but still they have to go out and sell it themselves, whereas the brokers would be able to just create these FICATs. And the way I like to think about it is, sorry, excuse me. The way I like to think about it, uh, imagine like a hospital system, where you get sick, and they're going to prescribe you some medicine. Well, what if like this whole chain of hospitals in the state of Texas? Well, what if this whole chain was creating their own, doing all the research and development and creating their own medicine versus, uh, and then like in the state of Louisiana, chain of hospitals are also doing R&D and manufacturing their own, medicine. Well, that's just really inefficient. And that's basically what a negotiable CD is. They're creating their own CDs for their own funding to create the loans. Uh, Whereas a FICAT, it's kind of like a pharmaceutical company. They do all the R&D and then manufacture the drugs, and then they just sell it to all the different, hospitals, pharmacies that need the medicine. And so this is kind of like what a FICAT is. It's not made by the individual banks. It's sold to all the banks that all the banks can take advantage of. So, and so isn't a FICAT just a negotiable CD? Well, so like I was explaining, negotiable CDs are very similar in terms of liquidity and purpose. In fact, right now, they're number two in terms of liquidity, right behind T-bills. Which, by the way, if you don't know what T-bill is a year or less maturity um, treasury. It's a type of treasury issued debt, which whenever you buy a T-bill, you're basically buying the debt of the U.S. government, at which point, so they can fund themselves until income tax revenue comes in, which they then, pay out the T-bills. And then, so negotiable CDs are created by the individual commercial banks for their own use. I already said that. And then the FICATs be created and traded by the investment banks. So, I kind of believe that these FICATs can possibly replace negotiable CDs, and I think the banks would be happy about this because it's less time and money that they have to spend creating these when they can quickly call up the broker, and I mean they'll do it online, I'm sure, where they just put in an order for FICATs, so they can have their funding, and then boom, there they go. Um, don't have to worry about trying to market themselves like, hey, customers, give us your money so we can lend it to you. None of that. Um, Okay, so do FICAs, do they compete with T-bills? Well, yeah, they do. A T-bill has the least amount of risk, so they'll probably always trade more. But the benefit of these FICAs is that they're pre-tax. So, I mean, I don't know, maybe possibly they might be more popular than T-bills. Now, obviously, they're not going to be as risk-free because the federal government, that's full faith and credit of the federal government. Whereas, but these FICAs are based on cash, which has the full faith and credit the federal government behind it. So I believe it's going to be very close in terms of which one is more popular. I guess what time will tell. But if I one possibility I see with these FICATs is that, let's say, the investment bank broker, they're buying and selling these every day. Now let's just say that there's a little bit of a surplus held by the brokers. Well, I think it's possible um, that the FICATs could be used to invest in T-bills until a bank wants the FICAT, at which point then the FICAT fund would sell its T-bills, which the broker was making some money. Um, they'll just sell the T-bills, which somebody will come and buy the T-bill, and then the FICAT goes to the bank. So in a weird way, they're competing with the T-bill, but they could also be used to purchase the T-bills because they are just their underlying asset is cash, so use it to buy a T-bill. So I'm sure it's going to be a common question is, well, why don't the banks just borrow the funds from the Federal Reserve? Well, the Federal Reserve is the lender of last resort, and so they strongly discourage banks from borrowing from the Fed. And if a bank does borrow from the Federal Reserve, it's got a very negative stigma associated with that. It's a sign of desperation when a bank borrows from the Federal Reserve, and it makes a lot of people nervous. It makes them not wanting to invest with a bank anymore. So, borrowing from the Federal Reserve, you're just not going to see it too much. Now, FICATs, I believe, should absolutely be viewed as an optimistic action because I think it's showing that the bank is ready to expand if they're taking on these FICATs. Now, because I mean, obviously, they're still going to have members in their banks, customers that are going to deposit their money. Um, but these FICATs, I mean, it's such a huge influx of cash that um, when they're borrowing this amount of money, that it should be seen as like, hey, we're ready for more money to start lending out. And obviously, if we're talking about a small town bank with a population of 1,000 people, they're not, they're probably not going to go out and borrow $1 billion in FICATs because they're not going to lend out $1 billion. The banks are going to just borrow what they feel like they need to meet their needs for their people. And so the next question is, well, how can we trust that the banks won't make too many bad loans? If they're like, you got Farmer Joe is like, hey, I think there's oil in my farm. I just need, $20 million to set up some rig equipment to drill. Hopefully there's oil. And the bank was like, well, hey, there's all these FICATs, let's just go ahead and give you the money and see if you're right. They're not going to do that because, these are short maturity FICAS, 1 year. Now, obviously, they're going to go out and get more FICAS to replace those that mature. But because but in theory, which proves to always be right, the maturity is very short. So the banks are going to need to be very judicious in the loans they generate because the principal and interest has to be paid back. I mean, there's no option. I mean, they're always going to be paying the interest, so they can't be making too many loans because they're paying back the dividends to the FICATs, 2%. And if they're not receiving the payments from their customers, well then the bank's going to become delinquent in their payments, and they're going to have to sell their assets. Well, what are the assets? Their assets are loans. So another bank will come in and buy their loans. The bank will go out of business, and when they buy the loans, they're also buying the FICATs. So the FICATs don't ever go away. Um, Someone's going to be responsible to pay those FICATs. And then um, I also feel like, with negotiable CDs, those are covered by the FDIC, the Federal Deposit Insurance Company, which cover up to $250,000 per account. Now I'm thinking that a FICAT could also be $250,000. So the FDIC could cover, $250,000 FICAT. Now, I mean, will they? I don't know. We'll see. But I believe that's perfectly reasonable because they cover negotiable CDs up to $250,000. So I think they'll cover these FICATs. Okay, so uh, next question here. So will this cause another recession like in 2007 from the subprime loan lending crisis? No, it will not. Um, you know, this would be like blaming the Great Recession on savings and checking accounts. It's just not appropriate to really link a FICAT to what could possibly go wrong. The idea probably is that like, well, you're increasing the amount of credit available to banks, which could cause a credit boom, and then ultimately a credit bust, which are the worst types of you know activity of the economy. The Great Depression in the 1930s, and then the Great Recession back in 2007. Um, but just from all the Dodd-Frank, Wall Street Reform and Consumer Protection Act, and just other macroprudential regulation, it gives enough checks and balances in the banking system to prevent FICATs from being the source of a credit-induced crisis. Um, and then, like I said, FDIC insured, I presume, like negotiable CDs. I think FICATs will be protected. So you should feel safe when a corporation invests in these. I don't foresee it being a problem. So how will FICAs be traded? Well, like I said, the commercial banks are the ones that are going to be using the FICAs as their source of funding. And the commercial banks are like Bank of America, Wells Fargo, um, your small, First National banks that are in every town. Um, whereas the bank, and then there's the investment banks. Those are like J.P. Morgan, Merrill Lynch, Bear Stearns that went bankrupt, um, Goldman Sachs. Uh, I think they're the ones that will be creating these FICATs that will then be trading them. They'll be doing the bid-ask spread and then generating these and selling it to the corporations to be used by the commercial banks. Um, and then also possibly pension funds. Well, I'm guessing pension funds would like to use this. Charities, because remember this is a very liquid asset. So pension funds and charities they have to have some cash just sitting by idly by in a liquid state, which put in just regular savings account. I mean that doesn't really do anything. There's really no interest on that. But with these, you're getting a little bit more, so they're making a little bit more money while they can use it right away, kind of situation. Um, small fee will be, like I said, a small fee will be charged to create the FICAT. Slim bid-ask spreads will be used to sell and buy the FICATs in the secondary market. And so we're wondering how liquid are the FICATs? Well, I mean, I know I've said a lot about this already, but I believe FICATs will be second only to T-bills in the secondary market. Definitely more liquid than negotiable CDs. And so you might be wondering, well, which is it only in the U.S. that we can use these FICATs, or where can we use this? Well, I believe that this FICAT can be used in any developed country with a money market and a strong lending system that can take advantage of FICAT. The basically, North America, Europe, parts of Asia, Australia, maybe Chile in South America. Um, but you know, you got to have a good banking system, a good lending system, um, and so I really believe that if you got good, I just think you can use it pretty much anywhere, and I also think that it can be used for foreign trade. So there's these things called euro dollars where corporations in Europe like say an American corporation buys a product from a European corporation in Europe, they'll pay in dollars. Well, Europeans, they don't want to necessarily trade those dollars into euros, um, so they'll keep it as a euro dollar at the London Exchange Bank, um, called euro dollar. And I can very well see that there'll be variations of these euro dollar FICATs. Um, there can be euro yen FICATs. You know, uh, I know I'm just this a presentation on FICATs, but I think there's a lot of ways this can be used that can really just benefit society. So, all right. So, what are the different reasons why a corporation would be interested in investing in FICATs? Well, like I said, it's a very liquid market to park your funds for very short intervals of time. But at the same time, you could keep this for a very long amount of time. Um, an insurance company is a perfect example of this. Not necessarily like the life insurance agencies, because they have pretty good actuarial tables on how long someone's going to live, so they know about how much cash they should have at any given time for their payouts. But like car insurance companies, maybe medical, uh, well, medical they know their stuff too. But car insurance companies, they got to have a lot of cash on hand for payouts, for unexpected payout on policies, and so a FICA would be, I believe the best place to keep it because will keep their cash liquid for their payout requirements, but at the same time they're making better investment than say on a savings or checking account. Uh, and because you know you might also think, well, hey, they could also just buy T-bills with it. Well, they could, but I'm thinking that it could be pre-tax dollars that they're sitting in these FICATs. And remember, pre-tax dollars, FICAT, and then they only pay the taxes when they pull their money out of the FICAT. So if they kept that money in there for a few years, because they were overzealous on how much they felt like they had to keep liquid, um, they're not paying taxes on that for a few years. So it's kind of helping them out. Um, and then once they do the payout, well then, hey, okay, now they're paying their taxes like they should be, but they also made their dividends at a pre-tax rate. When I showed you that 53% higher dividend rate than after taxes. So I think that's a great example of like why this is really a good short-term or long-term investment to park your money. But also companies, uh, you know they they have to park their money for payroll. You know, they're not going to just, they have their, a lot of corporations have their projects that they invest into, but they have to have some cash aside, set aside for salaries, bonuses, and so one advantage I can see of this is they set their money in a FICAT, and then they have their payroll deduction tied into the FICAT somehow. I don't know how they do it, but somehow, and they pull that money. The money gets withdrawn from the FICAT or like an assurance, so it goes to the employees, and then the FICAT gets sold, and it was all pre-tax until it got paid to the employees, which there's taxes on the employees that the corporations pay, so it'll kind of help them out with their corporate tax rate anyways. But yeah, so just another example. And well, that's it. Really, thank you so much for watching. If you've made it all this way, I know it's a long video, but I really hope you enjoyed it. I've had a lot of fun giving this presentation and creating this FICAD. I've been working on it for quite a while, so it's finally a nice relief to have this all finished and get to share it with everybody. And if it doesn't become a thing, that's okay. But if it does and it helps a lot of people, I think it really can just really help a lot of people, and I'll feel great. So I hope you enjoyed. If you ever have any questions about this, please feel free to email me. My name again, Andy Multer. So Andy Multer at .ficat@gmail.com. All right. Well, thank you. Have a great day.